The Bank of Canada is about to extend the pain as the governors seem to agree on only one thing, and that is that the rate cuts that are coming in the future are probably going to happen a lot slower than anybody really expected. And at the same time, the one thing that they are disagreeing on is when that first rate cut should happen and what exactly they need to see in order for rates to actually start coming down. In this video, I'm going to discuss the Governing Council's most recent deliberations and try to show you a little bit of insight into what they are thinking and how that could potentially affect you, especially if you're looking to get a mortgage or have a mortgage that's coming up for renewal in the near future. But before we get into it, my name is Nolan Matthias, and if you want the latest Canadian real estate and finance news, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. And if, by the way, you look down and you think, oh, I've already subscribed to Nolan's channel, why is it not showing me as subscribed? Well, that is because this is a brand new channel dedicated to the Canadian economy. So hit that subscribe button, and if you haven't already checked out the bigger channel that's more focused on global economic conditions, make sure you go subscribe to that one as well. Okay, so one of the most recent changes with the Bank of Canada is that they have started releasing the deliberations or notes on the deliberations that were had when rate decisions are made. And this is part of an ongoing effort, let's call it, to be more clear and transparent in communications, because communications, it now appears, or it's been proven, have just as much of an effect on the economy as the actual rate changes themselves. So the Bank of Canada, obviously going on the lines of what all the other central banks in the world are doing, which is communicating more openly and more freely in order to, I don't know, alter consumer sentiment and expectations in order to hope that they take certain actions so that the bank doesn't have to take drastic actions, seems to be one that they are committed to and that they are doing fairly consistently. And now, much like the Fed in the US, they're releasing the actual meeting minute notes of what they talked about when they went through and had the conversations about where rates should go and how long they should stay low for. And what I want to do is I want to take you through those deliberations. I've pulled out from what is otherwise a very lengthy document, the highlights, and I want to discuss what that means for you as a Canadian, as a potential homeowner, as a potential borrower, and pretty much as somebody who is just going to be affected by interest rates. So let's start by going in and just taking a look step by step at what was discussed. And then I'm going to take the very kind of economic complex explanations and translate them into more layman's terms. So these are all quotes directly from the summary of the Governing Council's deliberations. Obviously, this is for the most recent rate decision, which was April 10th. Of course, nothing happened. And there's a lot that they talked about here. And I want to start first with this. Governing Council began its deliberations by discussing the outlook for the global economy. Growth was projected to be stronger than previously expected in 2024 and 2025. This is globally. And the US economy accounts for a substantial portion of that increase. So I think it's important to note that they began by discussing the global economic conditions. They didn't start by talking about what's going on in Canada. They started talking about what's going on in the States and what's going on in other countries. And the reason for this is because Canada, as a net exporter, is largely dependent on a lot of other economies. And of course, it's no secret that what the US Fed does has a direct impact on what happens to the Canadian dollar and what happens to the Canadian economy. So they started first with this piece of the conversation. And Governing Council members expected inflation to continue to ease gradually in most major economies, which is very much widely expected, especially given the fact that most central banks increased interest rates quite drastically. And in a lot of cases, it's arguable that they went far beyond what they needed to. But nonetheless, it seems to be a trend globally, especially now that all the shipping stuff has figured itself out and a whole bunch of other things have figured themselves out, including oil prices and whatnot, that for the most part, all over the world, inflation is gradually coming down. The only thing that is unclear is when it'll come back to that 2% target that, of course, was famously arbitrarily set by the New Zealand government back in like the early 1990s or early 2000s or whenever it was. Well, the question is, when will it actually come back to that target? And that is the question that economists are basically waiting to answer. They're trying to figure out. And of course, there's forecasts associated with that, but the forecasts are only that. They're forecasts. And just like the weather, when you get a weather forecast, it's not always accurate. In fact, it's quite often not accurate. And that's exactly the same case with respect to inflation forecasts. Now, members focused their discussion on the significant upward revision to the projection for growth in the United States. Consumption in the United States has been repeatedly stronger than expected. And this is with respect to the GDP numbers in the US and the fact that the economy continues to grow even in the face of higher interest rates. And we've seen this with the Fed in the US. They're talking now about higher rates for longer. And obviously, that is to do with the fact that even with the higher rates, the rates that are higher than what they believe they should be, the economy is still booming. And it is very rare for a central bank to reduce interest rates when an economy is not at least heading for a recession or already in one. So, this creates some potential problems for Canada, especially as the Bank of Canada looks to lower interest rates, which, by the way, we aren't heading into a recession either or not in a recession. So, the fact that we're looking at lowering interest rates is also abnormal. And the governing council, they agreed that there was a risk that the US GDP growth could again prove stronger than expected in 2024. And of course, that becomes problematic for Canada. And if that becomes problematic for Canada, it likely means that interest rates are going to have to remain higher. Now, Governing Council also reviewed the developments in the Canadian economy and recent data on inflation. So, this is where we're going to start talking about Canada. And after stalling in the second half of 2023, economic growth was expected to strengthen in early 2024. Now, this is where it becomes somewhat problematic because if economic growth strengthens beyond what is expected, that becomes inflationary. And if that becomes inflationary, then all bets are off the table when it comes to interest rates. But here's the good news. Inflation had eased to 2.8% in February and was projected to remain around 3% in the first half of 2024, broadly in line with forecasts in the January report. Inflation was expected to ease below 2.5% in the second half of the year, reaching the target in 2025. Now, I need to point out here that they're expecting it to reach the 2% target in 2025. When it reaches that target is typically when you would start to see a central bank lower interest rates. But obviously, they're talking about lowering interest rates now, which, like I said earlier, is definitely abnormal. And then members discussed in detail the impact of population growth on their outlook. They agreed that the rapid increase in the population, as well as the future decline in the share of non permanent residents announced by the federal government, complicated the outlook for economic activity and inflation. Because if we have more people and they are taking up resources, that creates higher demand, and higher demand means potentially higher prices on things, and therefore it is inflationary. But this is where it gets interesting because I love this next line here. Governing Council spent considerable time discussing recent data on inflation. Members were encouraged by the recent progress on CPI and core inflation, and CPI trim and CPI median had eased to just above 3% in February. Now, the fact that they are encouraged by this progress means that they believe that things are heading in the right direction. But as you'll see a little bit later on here, that doesn't mean that they're going to start lowering interest rates because there are actually some disagreements about what is actually happening here and when the right time to do this will be. Now, overall, the governing council members were confident that their outlook for inflation was reasonably balanced, with core inflation measures expected to continue to ease gradually. However, with higher global oil prices, total CPI was expected to bounce around 3% over the next few months before easing to below 2.5% in the second half of the year. Now, of course, they're always going to be confident that their outlook for inflation was reasonably balanced because it was their outlook for inflation. And of course, they're going to believe that they were right. But that doesn't necessarily mean that they're going to be right. And they continued their discussion from previous meetings about the conditions that they needed to see to be confident that they were right, that inflation was on a sustainable track to the 2% target. And this is where that confidence factor comes into play because there's different levels of confidence among different board of governor members, which is making the decision to lower interest rates significantly harder. And if they don't have at least a reasonable amount of agreement on what should be done, well, that means that they're probably going to do nothing, which means we may not get those rate cuts as fast as expected. And like I said at the beginning, they are definitely all agreeing that those rate cuts are definitely not going to come as fast as previously expected. They will be drawn out and done over time so that they can be sure that when they do lower interest rates that they aren't going to create an unsustainable amount of inflation because they just lowered interest rates. And they agreed that corporate pricing behavior was normalizing. So, in other words, companies were slowing down the pace of increases to payments or increases to prices and increases to costs and everything else. And analysis of CPI microdata demonstrated that firms were raising their prices less frequently, consistent with the findings of the bank's surveys, which is good news because, as you'll see in a second here, what companies do with respect to pricing has a pretty significant impact on the economy. And members view the inflation expectations of businesses as an indicator of future inflation because businesses tend to be forward looking when they set prices. So, this is why it is so important for central banks to take a look at what businesses are doing as opposed to what consumers are doing. Because consumers basically go, hey, how much money do I have in my bank account? That seems like enough for the month. I'm going to go and be a spendy pants. But businesses, on the other hand, they look towards the future. They look towards the next quarter and the quarter after that, and they will adjust their costs appropriately. They'll adjust their spending appropriately and they'll adjust their debt appropriately. And when companies stop raising prices, that can be a lead indicator to the fact that inflation is, in fact, going to stabilize. And that seems to be the message that is being sent from the businesses across Canada is that the increases to prices have started to come down. Now, members then discussed when they might be confident or how much assurance they needed that inflation was sustainably on track to reach the 2% target. Now, this is where it gets really important because this is where they're talking about what they need to see, and this is where there is a significant amount of disagreement. Some members emphasized that with the economy performing well, the risk had diminished that restrictive monetary policy would slow the economy more than necessary to return inflation to target. And additionally, stronger domestic demand coupled with robust US growth could keep core inflation from slowing further, or it could even pick up again in the event of new surprises. They felt more reassurance was needed to reduce the risk that the downward progress on core inflation would stall and to avoid jeopardizing the progress made thus far. So, this is the side of the Board of Governors that believes that maybe we should just hold off on reducing interest rates. And by the way, this was brought up first in the summary of the deliberations. So there's clearly at least a few of the Board of Governors that believes that they should not be reducing interest rates and maybe holding off. Now, then there's the other side. There's the others that placed more emphasis on the progress made in bringing inflation down. Inflation across most goods and services had come down significantly, and coupled with indicators that the economy was in excess supply and with a base case projection showing the output gap starting to close only next year, they felt there was a risk of keeping monetary policy more restrictive than needed. So, in other words, this side is saying, well, if we keep it too restrictive, we could actually put ourselves into a recession, create unemployment, and wreak a whole bunch of unnecessary havoc. So there's clearly two different opinions here. And the thing is that the Bank of Canada is going to have to find the center ground on this. And more than likely for the Bank of Canada to find themselves in agreement, they're actually going to have to see economic data that sways one side from the side that they're on to the other side. I can't see a world where certain members of the Board of Governors change their opinions just because they are talked into it. They're literally going to need to see the data before they decide that a change is warranted, which means we could see these rates stay pretty steady and pretty flat for a considerable amount of time if there's no significant changes to the inflation data, the GDP data, the employment data, or any other number of types of data. Now, as in past meetings, members discussed the risk that housing market activity could accelerate and further boost shelter prices. Members acknowledged the easing of monetary policy could increase the likelihood of risk materializing, regardless of when the easing cycle begins. So, in other words, what they're saying is that if they lower interest rates, this could create another boom in the real estate market, and that, of course, has an inflationary effect. So then the question becomes, well, are they going to decrease interest rates? Are they going to increase interest rates? And if you don't know the answer to that, which it seems the Bank of Canada governors don't know the answer to that, well, you better have a good mortgage broker, especially if you have a mortgage coming up for renewal in the next 4 months, or you're thinking about getting a mortgage in the next 4 months, because rates are all over the place right now. It doesn't seem that anybody is certain about where they're going, which means a rate hold from a good mortgage broker is going to be imperative if you're in the market in, like I said, the next 4 months. Now, if you want a great mortgage broker, the best place to go is mortgage360.ca, where my team can help you. I have the absolute best people who always put the client first, and they would be more than happy to help you with your mortgage needs to make sure that you have those rate holds in place. So, in the event that interest rates do start to go up, like they have in the bond market, which is going to push fixed rates up, you are protected. So, mortgage360.ca, apply online, and that should give you the information, the protection, and the good feelings about interest rates that you need, knowing that you're covered. Now, to take that one step further, though, governing council members also discussed mortgage interest costs and how they should be treated from a monetary policy perspective. So, whether or not they should be included in the inflation data, and if housing should be something that they're considering when they go to lower interest rates. And they agreed that focusing on the bank's preferred measure of core inflation, which is TRIM, allowed them to effectively look through mortgage interest costs. So, in other words, if they're looking at the inflation measures that discount mortgage interest costs or discount any outliers in the economy that are significantly higher from an inflation standpoint than the majority of the economy, well, they should be able to look through those and make the proper interest rate decisions. But that doesn't mean that if they look through interest costs and lower interest rates, that it isn't going to create more inflationary pressure, which could filter through the rest of the economy. So while they think that they may be able to mitigate this if they were to lower interest rates and that could potentially create a boom in real estate, they're also well aware of the fact that lowering interest rates and creating lower interest costs could actually filter through to the entire economy, which of course would be bad and would cause interest rates to go back up. And then members also discussed the path of population growth. Obviously, this is the huge topic. And this is where I really love the deliberation here because they talked about the projections based on what the federal government has told them that they will do. But here's the kicker: just like everyone else in the country right now, the Bank of Canada isn't so sure that the government's going to do what they said they were going to do because they put this little line in here and it says, but details of how these plans will be implemented had not been announced. Governing Council recognized that there was some uncertainty about future population growth and agreed it would be important to update the population forecast each quarter. In other words, we need to update this each quarter because we aren't sure if the government is actually going to do what the government said. And overall, Governing Council agreed that inflation was still too high to lower interest rates, at least in April. Now, will it happen in June? Who knows, but it's looking like that could be less likely to happen. Governing Council members agreed that they had seen further recent progress in core inflation and in key indicators of underlying inflation. Well, there were different views on how much more assurances was needed to be confident that inflation was on a sustainable path back to the 2% target. So, in other words, they disagree on what they need to see in order to be absolutely certain that they're going to hit that 2% target. Because let's be clear here, we're talking about interest rate cuts when we're actually nowhere close to having inflation back to the 2% target rate. Yes, I get that 3% seems close, but in the grand scheme of things, we're actually a long way from actually being at that target. Probably a year to a year and a half away, unless something surprising happens in the economy. And to take this one step further, I want to pull out this last line of this quote, which is members agreed that the decline in core inflation in January and February was further easing. And they wanted to see that easing sustained. So in other words, they just don't want to go, hey, yeah, it's getting better, so now we can make the move. They want to see that it's getting better and it's staying better before they actually do anything. So while there was a diversity of views about when conditions would likely warrant cutting the policy rate, they agreed on one thing, and that's that monetary policy easing would probably be gradual, given risk to the outlook and the slow path for returning inflation to target. And I want to be clear here, here's what that means for you. Is if you're looking at a mortgage right now and you're thinking, I'm going to get a variable rate because rates have to come down and they're going to come down fast, well, the Bank of Canada has changed its tone and they're clearly saying that that isn't the case, which means selecting the right mortgage today couldn't be more important. It means you want to make sure you definitely don't get a discounted mortgage that prevents you from getting a lower interest rate if interest rates do go down. And you definitely don't want to be getting a mortgage at a B lender, a B lender, because banks have inferior mortgage products. And I'm not saying that because I'm a mortgage broker. I'm saying that because the single biggest weakness that banks have in their mortgage products, especially with respect to fixed mortgage products, is the payout penalties. And if interest rates do indeed start to go down, you want to make sure that you're set up so that you have a mortgage where you can get a lower interest rate. And you won't be able to do that if you have a big bank 3, 4, or 5 year fixed mortgage. So don't get your mortgage from a B lender. The banks love to call mortgage broker lenders the B lenders. But the reality is the products that mortgage brokers offer and the lenders that they deal with both have to actually have a better product because if they didn't, they wouldn't exist. And when we deal with companies like First National, MCAP, CMLS, we're dealing with lenders that deal with the A++ best of the best clients. They actually can't do a lot of the things that the banks do for the B style clients, which again makes them the A++ lenders, not the B lenders, as the banks would like to call them. Oh, and if you want more information on what's happening with interest rates and what the best non-B lender rates are and non-discount lender rates are, although I do have the discount rates in that video as well, make sure you go right here and check out this video.